Hey everybody, it's Dean Barber, founder and CEO of Barber Financial Group. So, there's a lot of things happening out there. We just passed Halloween. It's supposed to be the spookiest day of the year. We're coming up on elections, and some of you may actually be seeing this video on election day. What's ahead? We have a global pandemic that we have rising cases going on right now. And this election and the economy, there's so many different things going out there. There's so many different questions about how should you be positioned? What should you be doing? Join me for the monthly economic update here as I explain to you what I see, what I think, and where I think we're headed in the future. Okay, so let's address the 800-pound gorilla in the corner right away. Let's start with the election. Now, as I said in the intro to this video, most of you will be seeing this video on election day. We've posted it out to social media a few days ago, but most of you who are receiving this through email are getting it on election day. We think that there is a good chance that we could have a contested race here. We may not know who is the new president of the United States for a few days, maybe even a month. If we go back to the year 2000 with the hanging chads in Florida, it was December 12th, I believe, before we found out who the president was. So I'm going to talk about what the markets act like during that time of uncertainty, because if there's anything that the markets hate, it's uncertainty. But before we get into that, I want to shed a little bit of light on a historical basis of what happens with a Republican president versus a Democratic president, whether we have a unified Congress, a unified government, or a split Congress. Now, I'm going to start with the very best case scenario from the market perspective and take a look at this chart. If we look down here, if we have a split Congress and a Democratic president, the average annual return in those years has been 13.6% on the S&P 500. You can't find another return that is the same. Now, when we have a unified Congress with a Democratic president, we have a 12.96% average return. A unified government with a Republican president, we're at a 12.95% return. Worst is a Republican president and a unified Congress, and that is a 4.91% return. So, as we look at this, we can't really say that who's in the White House or who controls the House or who controls the Senate dictates the direction of the stock market. Because the reality is that you and I, we dictate the direction of the economy, which in turn dictates the direction of the market. What do I mean by that? The American consumer is responsible for 70% of every dollar spent in the United States, also known as the GDP. So as the American consumer goes, so goes the economy, and then the markets follow. The biggest threat that's facing us today, and I talked about this a little bit last month, is not a Biden victory or a Trump victory or a Democratic sweep of the House and Senate or a Republican sweep of the House and Senate. Let's set politics aside. The biggest threat that we have to our economy and to businesses and to people's individual livelihoods is COVID-19. Unless we have an effective treatment or a vaccine, the American consumer will not feel confident that they can get out and spend money and live the life that they want to live. Therefore, consumer spending suffers, and when consumer spending suffers, the economy suffers, and when the economy suffers, the market suffers. So the key for all of us getting back to a happier, healthier life with more clarity and vision of what we're going to see into the future is going to rely on our medicine, and that is either an effective treatment of COVID-19 or a vaccine. So let's all pray that that can happen soon. Now, let's talk about what happens in contested elections. I'm going to take you back to the 2000 election and talk about the contested election. The election was held in 2000 on November 7th, as you can see here. And we've got a little bit of a busy chart here, so let me just explain to you what we're looking at. The blue line here is the S&P 500. The green line is the Russell 2000 index, which is your small cap index. And then you've got gold prices, obviously in gold. And then the orange here is bonds, what's happening with bonds. So you can see on November 7th, we had the election. and we didn't know. It was a contested election. Who won? Who's our president? We didn't discover that until the Supreme Court decision was issued on December 12th of 2000. Now, the markets still were in a very volatile state, and they rebounded nicely here. So we had some drawdowns, obviously. The Russell 2000 drew down by about 7%. The S&P 500 drew down by 4.87%. But there's a difference in 2000 versus 2020. And the big difference is this. In 2000, we were 1 year in to the most god-awful bear market that lasted for 3 years. You remember the dot-com bubble burst early part of 2000, right? So the question is, was the result that we saw here of what the markets did in that month after the election as a result of a contested election, or is it just coincidence because that was the beginning of a protracted 3-year bear market due to the continued fallout of the tech bubble? Don't really have an answer for you there because we really can't say what causes it. We can't say what causes market volatility on a daily basis. What I can tell you is that this is a time that it's very, very critical that you have a strategy, you have an allocation, and this is not a time where you want to go out and take on additional risk or take on more risk than what you actually need to take on in order to accomplish your financial objectives. That's why it's critical that you have a comprehensive financial plan done and that your investments are being driven in the direction that you want to go, and understanding that there are going to be bumps in the road and understanding that you have a strategy that's going to give you the best possible chance of meeting your overall objectives. So with that in mind, I'd like to just say this. Make sure that you're reviewing your portfolios with your advisor. Make sure that you're talking to them about your plan, how the structure fits in, what the plan of the portfolio is, and we talk to you all throughout the year. So hopefully you're going to say, yeah, Dean, we just talked to our advisor about this last week or last month or last quarter. But point is, make sure that you understand that we want an open line of communications and we want to be here to answer any questions that you have. With that, let's go to what happened in the market here in the last month. Now remember, I'm recording this as of the 28th day of October, and so we're going to miss a few days between this date and the time that you actually view this video. And so we're going to look at the latest month in the markets, and we're going to look at the latest week because there's been some crazy things going on. Now, the day that I'm talking, you might have missed it, but the Dow Jones Industrial Average down by roughly 750, 800 points as of the time that I'm recording this. The market's not closed yet, so I don't know exactly where it's going to close at. Most of the indices off around 2.5 to 3.5% today, just depending upon where we're at. Take that out of the equation, and let's just look at the 1 week trailing here on the 28th of October. So the Russell 2000 is actually our best performing. That's the small cap sector. It is down only by 1.6%. The Dow Jones Industrial Average at that point down 2.93%. Over the last 1 month, the best performing sector of the market has been small cap, up 5.6% in the last 4 weeks, where the Dow Jones Industrial Average is a negative 1.02. But if we take that out and we look at a year-to-date period, negative 11.33, best performing NASDAQ up 32.95, Dow Jones Industrial Average minus 3.66, S&P 500 falling in just a little over 5%. So I pointed this out to you guys last month, and that is that we have this wide divergence in the returns in the market. So it's not an all-encompassing market rally this year. We do have the Dow Jones Industrial Average on a year-to-date basis in negative territory. We got the S&P 500 up a little bit. Last year, the Dow did extremely well. Small cap didn't do very well last year. It's not doing very well this year, but in the last month, it's actually started to pick up some steam. So maybe there's some value that's being seen from the big institutional investors. One of the things is always for sure is that we don't know exactly which sector of the market's going to do the best. We do have several tools that we use to follow and try to follow those trends. The best plan, though, is to have a good strategic investment plan that can go through all kinds of market cycles and let you live the life you want and have some fun. And God knows that COVID has got us all feeling a little bit panicked right now and a little bit restricted. And the last thing we want to do is to have your investments having you feel restricted or uncertain. So keep that line of communication open with us. By the time you see this, we're on election day or maybe a day after. We may not know exactly who the president is for a few days. Expect a video from me As soon as we know who the next president is, we're going to lay out what it means for the economy and what we believe it means for our investing strategy for the next 12 to 18 months. Remember, if you're not a client yet of Barber Financial Group, we're here to help. If you'd like to have a complimentary consultation, you can get that by clicking the button below and we will get in touch with you. We can have that conversation via Zoom meeting, telephone call, or we are welcoming in-office meetings. Thanks for taking the time to join me. If you're joining us on YouTube, make sure to give us a like, subscribe, and share with your friends.